about RBI's monetary policy review. In the review, which has been done on Friday, the Reserve Bank of India has left interest rates unchanged for the fourth time in a row. Now, repo rate is kept unchanged at 4% and the reverse repo rate at 3.35%. The projection for CPI inflation has been revised to 5.2% in the fourth quarter of 2020-21 and 5.2% to 5.0% in the first quarter and 4.3% in the third quarter. Now, GDP growth is projected at 10.5% in the range of 26.2 to 8.3% in H1 and 6% in Q3, that's third quarter. We'll try and understand all these figures and we'll also try and analyze as to what exactly does this mean in terms of the RBI deciding not to bring any change in the rates out there for the fourth time in a row. And for more on this, we're joined by a distinguished panel of guests. Let me first introduce them to you, beginning with Mr. Ashok Kumar Jha, former Secretary, Ministry of Finance, Government of India, is joining us. We also have with us Professor Aman Agarwal, Director, Indian Institute of Finance, and Mr. A.K. Bhattacharya, Editorial Director of Business Standard, is also with us. Welcome, all of you gentlemen, to Rajya Sabha Television. Let me begin with you, Mr. A.K. Bhattacharya. Let's start by putting these numbers in perspective for our viewers, given what exactly the situation is, and also the fact that RBI for the fourth time consecutively have decided not to touch the rates there, interest rates.
Well, I think it is very clear from what the RBI Governor, Mr. Shaktikant Das, said in his statement that the availability of money should not be an issue. And therefore, inflation assessment on his part will remain, and inflation will remain benign. So keeping those two things in mind, he has kept the stance of the Reserve Bank of India's monetary policy, which is largely composed of what kind of interest rates or the cost of money that should be in operation. So on the whole, it's a policy of continuation. But I think the real implication of this policy is not in what it has done by way of rates, but by what it has done outside the rates. Okay. I think it has addressed the critical question of a Government of India's borrowing of 12 lakh crore next year with a novel scheme by which retail investors can tap into the government bond market. Now, earlier, these schemes were announced through indirect methods, but now India joins countries like the UK, Brazil, or Hungary to have a direct route for retail investors to tap into the government bond market. This is essentially aimed at making sure that the government's borrowing program does not face any hiccups or any hurdles, because 12 lakh crore in a year of recovery could be a problem, even though liquidity is not an issue. Around 6.5 lakh crore of liquidity surplus is in the system. Nevertheless, the RBI has taken an advanced set of measures. One, by allowing retail investors to get into the government bond market. One has to see the details of it. And the second decision is to allow banks to keep their bonds, the government bonds, under the held-to-maturity segment. In other words, that they don't have to report the mark-to-market losses every quarter end, depending on the fluctuations in the bond prices. Now, this is what the banks were slightly worried. Therefore, the attractiveness of government's borrowing, attractiveness of the government bonds have been kept intact, and even though the CRR rates are going to be raised over a period of time, but I think the entire policy has to be seen from the way it has tried to manage the government's borrowing program without much of a hiccup in the bond market. In spite of that, please note that the moment the RBI governor did not announce any open market operations and the policy, the bond market, especially for the government bonds, the actual yields went up by around 10 basis points But my sense is that once this retail access to the government bonds, GSECs, as they say, is allowed, and the people in general can access those bonds and trade in them, that happens, that I have a feeling that the government borrowing program will not be that big, but such a big issue for the market. Rather, taken together with the retail access to the bonds and the held to maturity segment facility being extended for banks, for bonds, I have a feeling that this huge burden of higher borrowing, that challenge has been met and will be met. Let us see how these schemes are rolled out and how the market behaves in the coming days.
Okay, definitely. We'll have to wait for the final details out there, as Mr. Bhattacharya is pointing out. Let me also bring in Professor Aman Agarwal here. Professor Agarwal, from your point of view, these aspects vis-a-vis the monetary policy, not only keeping the rate unchanged, but as Mr. Bhattacharya is pointing out, the retail investor being allowed there in terms of the government bonds, government securities, that particular section vis-a-vis the government borrowing. How do you think this will all play out?
No, I think the first part, which is the unchange of the rates, is very critical because it is important to bring about a stable policy, given the framework that credit offtake still needs to take place and the economy is expected to get into a rebounding phase in this quarter and the next, given that the vaccine is out. So the fear factor in the people will reduce and they would like to get back to business and a more active role as against what they were in the past. So given that the credit offtake is expected to take place if the rates kept on low, and I think that is one of the important components. Also, the fact randomly changing rate policies, it becomes complicated not only for banks, but even in terms of the investors looking at it from a long-term perspective. So from that perspective as well, it is important that the RBI has taken a good decision of not changing the rates. This also shows that we are actually bottoming off in terms of rate reductions. And whatever will happen in future is going to go up. And that is what Shaktikant also said, that we're looking at an upward trend upside as a last comment towards his speech. Now, as far as the bonds are concerned, the 12 lakh crore, which is expected to be raised, certainly world over, people in large have more confidence in the central bank than the government per se, because the government bonds can be liquidated through seigniorage money, which is not normally done by the central banks, and they are well managed and have better positions. And that's where I think this particular framework which is being talked about is a better stand. People do have the liquidity in terms of parking, and I think raising this money would not be a difficulty, given that people are not investing extensively in other assets like the real estate or the gold, which they have been doing in the past. So they are looking at a stable investment avenue. A lot of people are also looking at avenues where they can actually go about. And fortunately, the RBI has allowed the retail investor to directly now log in, which was not the case earlier. And I think that gives a better edge. More than that, I also see the fact that this policy brings in the framework of growth component. The RBI is generally considered to be conservative in nature, and the fact that they are given out a 10.5% growth rate at the backdrop of inflation under control, because if you look at the economic survey figures, even the budget, it was projected at around 6% and above as the inflation. So they have been able to bring it down to 5.4% as corrected figures, and then it is expected to go down to around between 5 to 5.5%, which is fairly a good, comfortable rate given the kind of scenario, the kind of fiscal spending of about 9.5% or so, which has been projected in the union budget as has happened in the last 1 year. And I think given that the control of inflation with component, because both of them move opposite in direction, I think which the RBI has brought up.
Okay, definitely. That inflation part is also really important. We'll go to that as well. But let me first bring in Mr. Ashok Kumar Jha here as well, former Secretary, Ministry of Finance. Mr. Jha, the question here is that, the kind of monetary policy which has come out, how is it going to help the government specifically in a very crucial period as we stand now? We're trying to, come out of the shock of the COVID pandemic. Vis-a-vis the economic situation. So how do you think, after the announcements which you made in the budget, based on that, these policy, how does it complement that?
Yeah, actually, this policy of the RBI fits in very well with the budget projections that were made by the finance minister recently. In fact, the budget itself was focusing on growth, and this RBI policy will help in furthering that objective. See, by keeping the rates as they were unchanged, that is 4% repo rate, it gives a clear signal to borrowers that they can continue to borrow at a lower rate. And this in particular will help sectors like, say, the real estate or even the auto sector. See, in the auto sector today, most of the purchases are made by taking loans, and therefore, the cheaper the rate, the better it is for that sector. And similar is the case with the real estate sector. Mm-hmm. In addition to this, I think the fact that the RBI has also decided to allow banks to extend credit to NBFCs under the Targeted Long-Term Operation Scheme will ensure that banks are able to lend to NBFCs in a much more orderly fashion. Furthermore, I think they have got a new scheme that they've introduced to provide incentive to banks to lend money to MSMEs. See, those MSMEs which have not taken any loans up to 1st January 2021, there is a scheme that they have provided in this policy by which banks can extend credit to these MSMEs without that being counted towards their CRR. So this is all basically going to help the borrowers to access money to be able to further the objectives of growth of the economy.
Okay, so credit flow is something which is really important. As Mr. Jha is pointing out, that is where the focus of monetary policy also seems to be. Mr. Bhattacharya, I'd like to bring you in higher again. And then this time